The IRS has just unveiled the income tax brackets and standard deductions for 2026, and this update could significantly impact how much you'll owe next year. But here's where it gets controversial. These adjustments are meant to protect taxpayers from bracket creep, yet many still struggle with rising tax burdens despite inflation protections. Each year, usually in October or November, the Internal Revenue Service, IRS, updates these figures to keep tax brackets aligned with inflation. This adjustment helps avoid a tricky situation called bracket creep, where inflation pushes taxpayers into higher tax brackets without an actual increase in their real income or purchasing power. In simpler terms, without these updates, you might end up paying more taxes just because prices went up, even if your lifestyle hasn't improved. What's new for 2026? For the tax year 2026, with filings due in 2027, the highest federal tax rate of 37% will now apply to individuals earning above $640,600 and married couples filing jointly with incomes exceeding $768,700. Alongside this, the IRS has raised the income thresholds for several key areas. These include long-term capital gains, estate and gift tax exemptions, eligibility limits for the Earned Income Tax Credit. These changes were highlighted in reports by CNBC and ET. The standard deduction, which reduces taxable income and thus can lower your tax bill, is also on the rise. Married couples filing jointly can claim $32,200, an increase from $31,500 in 2025. Single filers will see their deduction bump up to $16,100 from $15,750. Heads of household can now deduct $24,150, according to CBS News. Extra help for seniors. The One Big Beautiful Bill Act introduces a noteworthy benefit for seniors. Taxpayers age 65 and older might qualify for a temporary additional deduction of up to $6,000. However, this perk is limited to individuals earning $75,000 or less, and married couples with combined incomes at or below $150,000. This deduction will remain available until the end of 2028. IRS challenges amid government shutdown. Here's a critical operational update. The IRS will implement an agency-wide furlough starting in October because of a government shutdown and resulting funding gaps. Despite this, taxpayers facing the October 15 deadline for extension filings are encouraged to proceed as usual. In fact, an IRS spokesperson emphasized to CBS News that the shutdown doesn't affect your obligation to file, deposit, or pay federal income taxes. Demystifying the tax brackets. U.S. federal taxes are structured progressively, meaning your tax rate climbs as your income rises. There are 7 brackets: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. To illustrate how these changes impact real people, consider a married couple earning $150,000 in 2026. Start by subtracting the new standard deduction of $32,200, leaving $117,800 as taxable income. This taxable income places them in the 22% marginal tax bracket. However, their effective tax rate, the actual average rate they pay, is lower because income is taxed at increasing rates only on amounts within each bracket. The first $24,800 is taxed at 10%, totaling $2,480. Income between $24,801 and $100,800 falls in the 12% bracket, resulting in $9,120 in tax. The remaining income from $100,801 to $117,800 is taxed at 22%, adding $3,740. Adding those together, they owe $15,340 in federal income tax, which means their effective tax rate is about 13%, far less than the top marginal rate. And this is the part most people miss. Understanding your marginal versus effective tax rate can change how you view your tax burden and your financial planning. Could these tax adjustments finally provide the relief many feel they desperately need? Or are they just a Band-Aid on a deeper issue? What's your take? Share your thoughts and debate below.